G'day everyone, it's Greg and Ryan back with you. We've got a special chat for you today. A question came up in the Q&A session we did with you. You should have received that yesterday, hopefully. I can't remember who it was, but the question was around blockchain and in the absence of middlemen, who actually verifies the transactions? How does it all work? So we thought we'd have a bit more of an in-depth chat on that, because there's a few questions that, or not questions, but a few phrases that have come to mind that I read a lot about, and I'm not exactly sure what they mean. And that's around proof of work and proof of stake. So maybe, and it's all related to the verification process. So perhaps we could get into that, and you could let us know in a bit more detail how it all works, mate.
Yeah. So, coming to a consensus, so allowing a system to come to a consensus of what is the true state of that system without having middlemen is a really hard problem to solve. And that is the central innovation behind Bitcoin, was creating a system which did that. And it's sort of, I've talked about this before, but banking and finance especially has evolved around, you need these middlemen, otherwise two sides of a transaction can't trust each other. So you need these middlemen to sit in the middle and sort of become the trusted party to facilitate several parties. And so have come up with a system which does away with that is such a huge deal. And people sometimes still don't think realize how big that is. But what in a blockchain system, what does that is called a consensus mechanism. So that is, if you're ever looking at a blockchain project, whether it's Bitcoin or Ethereum or Hashgraph or whatever project you're looking at, the first thing you want to look at is, well, how is this system coming to consensus without a middleman? And if you know that's what to look for, then you're going to get to the heart of, is this project innovative or is it not? Or what is the pros and cons to this system? Because a lot of projects sit on a spectrum of how decentralized they are in terms of their consensus mechanism. Some, for example, have trusted parties within a consensus mechanism. But Bitcoin, which is the first sort of blockchain system to come up with an alternative way of decentralizing trust, essentially, came up with a consensus mechanism called proof of work, right? And proof of work is just one part of the whole Bitcoin system, but it's the part that Bitcoin miners do. And what that does is it allows transactions to be put in order. So if you think about, we're going to provide a video on this, which is really good. It's 22 minutes, but you should definitely watch it because it explains this in more detail. But there's a few innovations in terms of how Bitcoin works. And the first is what they call public-private key cryptography, right? And that means if you've got a wallet, or if I've got a wallet, I've got a public address, which everyone can see. And attached to that public address is a private key, which only I know. And if I make a transaction from that public address, I sign that transaction with my private key. And that creates a digital signature. So no one can ever see my private key, but they can see that digital signature. And they can verify that only my public address could create that digital signature. So that's the first step in doing a transaction. I go to send you, say, 0.01 Bitcoin. I sign a transaction. I send that to your public address. And what happens there is there's lots of things called nodes, right? And with Bitcoin, anyone can run a node. You or I could run a node. There's over 10,000 nodes. And these nodes essentially listen for transactions. And when they see a transaction, they broadcast that to other nodes. All right. So I send you some Bitcoin. I use my private key to create a digital signature. A bunch of nodes pick that transaction up. And then every 10 minutes or so, a Bitcoin miner puts them into a block and creates a block in the blockchain. And that blockchain grows every 10 minutes or roughly and stacks upon each other. And that chain of blocks is the trail of transactions that have happened on the Bitcoin blockchain. So there's two things happen there, basically. There's the transaction happening, and then there's the ordering of those transactions. Now, the order of transactions is important is because you could have, people on different sides of the world and making a transaction, and there can be a lag. Your node might see my transaction now, but that other node might get that transaction a few minutes later, because there's a lag in terms of how networked computer systems work. It's not like things all happen instantly. And if you don't have an order, which is what the blocks are on the blockchain, if you don't put that in an order, then I could conceivably sign one digital transaction to pay you some Bitcoin, but then 2 seconds later sign it and to send it to someone else. And the risk there is called the double spend problem. And that's where proof of work comes in. It incentivizes miners, Bitcoin miners, who put those blocks in order. It incentivizes them to do that. And how they do that is, I don't want to complicate this too much, and the video probably explains it better than I do, but they're doing something separate. They're trying to guess some random number, which is a pure guess. And as they try and guess that random number, if they guess that, then they're allowed to put the next block on the blockchain. And once you're in a block, your transaction is confirmed to a degree. So until it's put in a block, your digital signature isn't confirmed. So if you sent me some Bitcoin and I went on the blockchain and I saw that was an unconfirmed transaction, well, I wouldn't be allowed to spend that Bitcoin until it was confirmed. And if someone else saw you trying to do the same thing, the system would pick you up trying to double spend. And so only one of those transactions would be confirmed. So that is essentially called proof of work. And so the Bitcoin miners are the ones doing proof of work. So they're trying to guess this random number, which is the way it's set up is all it requires is computational energy. So they're spending electricity costs and hardware costs to try and guess this completely randomly generated number. The more miners are doing that, the harder it is to guess that number. So that's something called the difficulty level. And if they guess it, they get to add the next block and get the mining rewards and get any fees associated with that block. And that's called proof of work, because the work they're doing is trying to guess that number, and they're paying a real life cost for that, which is dollars in terms of energy. So that's the consensus mechanism for Bitcoin. It's really powerful because it incentivizes different actors in the system. So users like me and you, we've got private public key cryptography to keep our funds secure. It's got nodes which work independently to verify that transactions are correct and to broadcast them to the network. And then it's got miners to order those transactions to make sure that transactions are at some point confirmed to a large degree. And that's a whole system. It's not just one thing. There's a few things I've talked about here, and you probably need to watch the video to make it make complete sense. But that's proof of work. If you move to another consensus mechanism, again, it's trying to do the same thing. It's just trying to find a way to make sure that the transactions with the system are verified as true and correct without having a middleman. So with proof of stake, which is another popular consensus mechanism, it's the one that Ethereum is moving to. It's not there yet, but it is moving to that kind of system. With proof of stake, you're not using mining, which uses energy costs and things like that. What you're doing is holders of those coins, of Ethereum, for example, or whatever crypto it is, they lock their crypto in to a contract, and then a program underneath that verifies transactions on the network. And if your program tries to do something malicious, you're at risk of losing a percentage of your coins that you've staked. So the incentive structure there involves holders, so people who own those tokens, locking up their tokens for some length of time and running a piece of software underneath that to verify the transactions on the network. And the risk there is that if you don't do it correctly, then you could have some of your stake slashed and lose some of your stake. So the incentive structure there is to say, well, if you try and confirm incorrect transactions or try and change the order, then you could lose some of your cryptos there. But that process doesn't use any energy like proof of work does. And there's trade-offs between two approaches. There's no right or wrong in this. They're both experiments to some degree. Some people would say that the proof of stake consensus mechanism rewards big holders disproportionately to small holders. And so that's an attack vector behind that. For example, if everyone's earning, say, 5% per year in stake coins, and I've got 1 million Ethereum and you've got 10, then I'm building up more Ethereum every year than you are. So I'm having a larger holding over time. So in a way, some people say it centralizes power more so than, say, proof of work, which doesn't reward holders of the coin any more so, depending on how much you have. So there's a few So between the two mechanisms, there's different attack vectors and different challenges, and but to my mind, proof of work is the more battle tested one. And some people complain about the energy use. That's a criticism of it. But in a way, the energy use actually ties it to a real life cost, whereas a proof of stake system, it has that no anchoring to real life. The price of a coin could crash. Someone could buy up a whole lot of it, and then they stake it, and they have an outsized control over it. So there's no external anchoring to the real world.
Well, I think a question that comes to mind with the proof of stake is that the owners, not all owners, but if you want to stake your Ethereum, you're staking it into this system. You've effectively got money on the line, but you're also getting something in return for that, right? So you're getting additional coins or some sort of rewards. Whereas under the blockchain system, it's done by all the node runners or the miners, and not so much the people involved in the actual system. What would you've just said that proof of work is more battle hardened, but a couple of things that I've read recently is that maybe the system is more moving towards proof of stake. I mean, is that something that you've come across as well, or is it really just a preference?
I think a lot of the newer cryptocurrency projects do use proof of stake. And Ethereum certainly is moving that way. And in a way, you're right. It does reward holders because they get to actively increase their holdings by doing a task for the system. So in a way, that's a good thing. Whereas proof of work, if you own Bitcoin, unless you're a miner, which not many people could afford to be, then you can't actively increase your stake. You can only benefit from capital appreciation. And even running a node on Bitcoin, you don't get anything for running a non-mining node. It's just the altruistic nature of trying to decentralize the network. But I think the value proposition of any cryptocurrency blockchain comes down to how decentralized it ultimately is. And I think even though proof of stake seems easier in a way, it's easier to build up a holder base, and you don't need to worry about the green issues or anything like that. There is still a lot, from what I read, I don't want to get too technical, there are a lot more attack vectors around manipulating proof of stake and it becoming more centralized over the time.
And is that via the concentration of ownership? Is that what you mean?
Concentration of ownership is one thing. Like Ethereum, for example, because it's such a complex system compared to Bitcoin, its nodes a lot of the time are run on like Amazon Web Services servers. So it's really centralized in a way, or another node as a service operator called Infura. A lot of decentralized apps built on Ethereum actually plug into this centralized node provider. So the question with Ethereum is, well, how decentralized are you? You might have 8,000 nodes around the world, but if 7,500 of them are on Infura and AWS, then you're not decentralized. So you've got a single point of failure. And I know from how much Bitcoiners thought about every single attack vector that they realize, it's very easy to break a decentralized system, and you only need one attack vector to work. So, for example, there's concentration of token ownership. There's concentration of nodes because you're trying to do something more complex, and it's harder for the average person to do it, to run a node. So yeah, I think. And this is very technical, and I'm by no means an expert on this side of things beyond the reading I've done over the years. But I think for decentralization, proof of work still wins hands down. It's still got some attack vectors as well, don't get me wrong. Like the concentration of mining can be an attack vector around Bitcoin, but people have known about that since day one. So a lot of solutions have been implemented or are getting implemented to mitigate that. I think proof of stake still has to prove itself as a decentralized infrastructure. I still love Ethereum, and I love all the projects that are built on it, especially the innovation around Ethereum is a lot better than, say, Bitcoin, for example. But I still acknowledge like the Bitcoin maximalist concerns, as it's called, in that, well, if you give up decentralization, you basically give up everything. So yep. I think the challenge for some of these proof of stake coins is to, fine, you're going to make it easier, you're going to involve holders, but if that comes at the costs of centralization and a single point of failure through some sort of attack vector, then that's too big a price to pay for innovation, short-term innovation.
It's certainly something worth keeping in mind as you see government institutions try to move in this space and try to dominate, and obviously that's one area that they would try to do it. Are there any more consensus mechanisms, or are they the two main ones?
They're the two main ones. There is another one which is called the DAG technology. I always forget what I think it's directed acyclic graph technology, right? So DAG technology, and there's a few cryptos like MadeSafe or IOTA. There's another one which I'm forgetting, but that's a different type of consensus mechanism. Again, is based on something called the gossip protocol. I don't want to get into that, but essentially, it's basically as these nodes are talking to each other about what transactions are making, it sort of comes up to a probabilistic a viewpoint of what the state of the network is, and it goes off that. It's pretty complicated. I don't want to get into it, but that's the other. I think that's the other one that is of use. Again, a lot of the projects like IOTA that were promoting this technology, Hedera Hashgraph is the other one. Even though they say this can be done in a decentralized way, a lot of them have a centralized controller right now because they say the system isn't ready to go fully decentralized. Right. So the breakthrough for them will be is when they say, all right, well, we'll let anyone be a node. You know what I mean? For Hashgraph, for example, has a federated group of nodes, which is big companies like IBM and things like that. And to my way of thinking as well, a federated group of big multinationals who run the nodes, what's the point of that? Yeah, you can do 1,000 transactions per second, but at the same time, you've just given up, sovereignty to banks to another group of multinationals that happen to be tech companies or tech aligned. So I think if any of these new technologies proves that they can do this without a federated group of controllers or without a centralized, fail-safe switch, which a lot of them have, then that'll be interesting. But again, the key advantage Bitcoin has is that it's been out in the wild for 12 years. It's had a lot of chance for people to try and break it. And it's still managed to stay very, very, very decentralized, albeit there's shifts in mining and stuff like that, but it still has managed to remain
its core structure.
Yeah, core structure has. And as Ethereum moves to proof of stake, because remember, they're not there yet, and they're taking their time with that. So they're obviously encountering probably more problems than they thought they would. I listened to an interview with Vitalik Buterin, who's the founder of Ethereum, the other day, and he said the initial vision of moving to proof of stake from proof of work was just going to be one swell foot, one big move, and then they've decided to do it gradually over time instead because they're trying to make sure they don't break anything in the process.
And what was the impetus for them making that move in the first place? I mean, if proof of work is so robust, why did they decide to move to proof of stake?
I think because Ethereum has a lot of smart contracts built in it, which are by their nature are a lot more complex than the way Bitcoin is structured. I think they needed a new consensus mechanism just to handle the sheer volume of transactions, and proof of work couldn't do it because the Bitcoin proof of work blockchain is fairly slow and clunky. You might get a new block added every 10 minutes. But there's a limited amount of space within those blocks, and that means the transaction costs can go up and down. That's not that fast for a financial network, but what they're sacrificing for that is the decentralization aspect. For example, there was a big fight a few years ago, I think 2015, about Bitcoin Cash and Bitcoin. There was a few splinter Bitcoin projects that came out of it: Bitcoin Cash, Bitcoin Gold, I think Bitcoin SV, and stuff like that. And what they wanted to do is, for each block that was created every 10 minutes, they wanted to increase the amount of transactions within a block. And they said that would allow more transactions to happen every second. It would keep fees low and mean Bitcoin could act more as cash, which, sounds fair enough. But what the hardcore Bitcoin developers rejected that was because they said the bigger you make the blocks, the less nodes can run. Because to run a node, you have to be able to keep a whole transaction list of the entire blockchain. And if you're going to make that data bigger, it's going to be very hard for the average person to run a node. And they said that was it should always be easy or fairly easy for anyone to run a node in the system. So the battle went around that for a few months, and Bitcoin, the big blockers were essentially beaten, and they went off and did their own thing, and the small blocks remained. And that was essentially to keep the network decentralized. So you've got all these battles happening all the time between different consensus mechanisms and different ways of doing things. And some of it can get quite technical, and some of it's over my head as well, to be honest. But I think the core ethos of what Bitcoin does always puts decentralization first, whereas some other mechanisms put maybe innovation first, or put even some really bad projects will put the growth and value first and won't really care about decentralization as a structure.
Yep.
And there's no guarantee that mass or ideological preferences will win out either, to be honest with you. Maybe Ethereum's proof of stake will win out because, like you said, it's something that you said JP Morgan can get behind. They can buy a big swag of Ethereum, stake them, earn 5.9% a year on an appreciating asset, and have huge control over a network which a whole bunch of multi-billion-dollar decentralized apps are built on. And that's a possibility. Whereas Bitcoin's the cranky nerd in the background that's complaining that people don't see his vision, and that could be the way it works out. Yep. But the interesting thing is that, and we had the announcement with El Salvador and Bitcoin earlier this week, and El Salvador have pretty much said they're going to build a financial infrastructure on Bitcoin. And I don't know how much work they put into this, or whether they've been led by some prominent Bitcoiners who've been working with them in remittance. But if I was a country looking to build on decentralized financial infrastructure, I would choose Bitcoin, because that's the one that can't be hacked. That's the one you can be most confident is unhackable. So it's not like someone can pull the rug out underneath you later on. And I wonder if that was something El Salvador considered when they declared that Bitcoin was going to be a legal tender in their country, and they were going to work with Strike and Blockstream and try and build out financial infrastructure on the Bitcoin blockchain. I wonder if that was a consideration from them.
Maybe it's worth just delving into that point a little bit more detail, because on the surface, you think El Salvador, tiny Central American country, it's not really a big deal either way. But I guess what we're looking at here is almost a first case, or a first user case of if it works for El Salvador, then other countries, especially Central and South American countries who do take a lot of remittance money and a lot of money coming back from the US, that is traditionally chipped away by the middleman, chipped away by various actors along that chain. But so by the time it gets to the end recipient, they're probably looking at 50% of what was originally sent. So this is potentially quite a big deal for Bitcoin, right?
Yeah, it is a test case, and that's it. And a lot of people have voiced, concerns about the government there, or the political regime. I don't know enough about that to say anything. But what I would say is, on the positive, is that I think it's like 21% of El Salvador's GDP comes from remittance money, and on average, they're paying up to 30%. I think in remittance fees to like Western Union and banks just for sending that money back. So you might send a couple $100 back a month to your mum or whatever, and she's getting, $150, $140 out of that. And so just by allowing using this app called Strike, which is run by a really smart teenage sort of entrepreneur called Jack Mallers, this app called Strike uses the Bitcoin network to allow almost free remittances back from the USA to El Salvador. Does it in a regulatory compliant way and all that. Has affiliations with big US banks and everything. So he's doing it in a proper way. But just by the act of having this app in people's hands in El Salvador, that is going to add 7% to their GDP, or that's what's estimated. So just on that aspect alone, this has a real value for poorer countries which rely on remittance money. And that's because using the Bitcoin network is almost free in the way that Strike are using it. So it's an awesome use case of the infrastructure of the Bitcoin blockchain. Not talking about the unit of account. We're talking about the actual Bitcoin infrastructure.
The architecture.
Yeah. The other point was, though, and this is maybe for the wider implications, is by potentially declaring Bitcoin as legal tender. So in El Salvador right now, they use US dollars because their own currency went collapsed in 2001. They use US dollars right now. But by declaring Bitcoin legal tender, potentially it opens up legal and accounting concepts elsewhere, because anything that's counted as legal tender in one country historically has been treated as legal tender everywhere else. And that has implications for accounting rules. It has implications for how crypto's treated as a tax, for capital gains tax and things like that. And it has different legal definitions. So in America, for example, in the US, I follow this lady on Twitter who runs a crypto bank in Wyoming called Caitlin Long. And she was saying under US commercial law, Bitcoin, if it's legal tender, will be treated as money. And if it's treated as money, then it can be held by banks under their regulatory regimes under Basel III and other stuff like that. So, I'm not saying this will happen, and I'm certainly not saying the powers that be will let this happen, but there is a potential for, subtle definitional changes of Bitcoin to be turned into money, and for that to have follow-on effects on other actors in the world, whether they're corporations or banks or whatever. The other point which you sort of made was saying, well, El Salvador is going to be a test case for other countries that are poor and are looking for a new system. So if it does work for El Salvador, you can imagine Guatemala or Honduras or a bunch of others in that Central American region trying to do much the same thing. You can imagine some Eastern Bloc countries in Europe trying to do it. You can imagine some Southeast Asian countries doing it. Because for them, we always forget this being in the Western world, the current financial system has pretty much ignored them and sometimes actively harmed them. I mean, the president of El Salvador said that, because of the US dollar, they've been basically importing inflation for their currency. The cost of bananas has gone up and stuff like that. So by relying on the US dollar, that can be okay for them sometimes, but other times it can be completely against their interests. So for them to take that first step in saying, well, maybe we can have an alternate system which we can rely on as well, an alternate unit of account. If it works for them, it's like when Britain introduced the gold standard. Every other country copied them because they saw the success of Britain in the 1800s. Yep. The same thing could happen with Bitcoin. I'm not saying we're there yet. There's plenty of people who are critiquing this move, saying that it will fail and El Salvador are a dodgy political regime and other stuff. But it'll be a very interesting space to watch, I think.
Yeah, it'll certainly will be. Well, let's just bring it back to the start of the conversation. So really just to cement in people's minds, proof of work, proof of stake are essentially consensus mechanisms that the different blockchains use to validate transactions, right? I mean, that's the basic simplicity of it.
100%. And they do that in a decentralized way by incentivizing people to do something. So in proof of work, they incentivize Bitcoin miners to act honestly and create blocks. And if they act honestly and they do that, they get newly minted Bitcoin and a share of the fees. In proof of stake, they incentivized a different bunch of people. They incentivize holders to lock in some of their tokens and generate newly minted crypto and a portion of fees. So it's doing the same thing, but in two different ways. But the important thing is what you've not got is you've not got any trusted middleman, and you've not got a delegated person or group of people. So anyone can become a Bitcoin miner within reason. If you've got the capital to do it, anyone can stake a crypto. And so there's no exclusion. There's no barrier to entry. Sometimes there's financial barriers, but there's no necessarily a barrier to entry to you become a validator on those networks and being part of that consensus mechanism.
Now, speaking of staking, I think that'll bring us to the next topic we'll follow up on down the track is what is staking? How do you go about it? How do you make some additional rewards from it? That's another topic in itself. So we'll get into that down the track. But for now, mate, thanks very much for clearing all that up. It's makes a lot of sense to me, and I'm sure it's probably cleared a lot up for our listeners as well. So cheers for that.
All right.
All right. Thanks for listening, guys, and we'll talk to you again soon. Bye. I hope you enjoyed that preview from New Money Investor. To get access to the full video and much more, please click on the link below.